Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing Microchip Technology stock, ticker MCHP. The stock is down over 40% off its highs right now. As always, this is not individual investing advice. This is just how I analyze stocks. I picked Microchip Technology for a couple reasons. The main one is it's been a while since I've done a video where I explain my Recession PE metric that I use sometimes. And I think this will be a good stock to use for that because if I recall correctly, in March of 2020, which is when I decided I basically had like the prototype version of this technique, I guess is what you would call it. I started using it in the middle of the March 2020 downturn or crash or whatever. And Microchip Technology was one of the stocks that I bought. And we ended up making like 140% on it in less than a year. So it's one of the better stocks that I've purchased since I started the Cyclical Investors Club in 2019. And the stock has been trading higher than when I sold. So let's zoom in here real quick. So let's see. I sold it in like January of 2021, sometime right around here, around, let's call it $75 a share. They had a stock split since then, but so it's been trading at these elevated levels, at least some of the time higher than when I sold it, and until now. And so the stock price is actually falling again. And this process, I would say, took a full year longer, maybe a year and a half longer than I would have expected it to, because I would have expected this to start in the beginning of 2022, which is when I had already sold the stock. Let's see, is that the beginning of 2022? Let's see, that's 2023. So, and it did actually sell off in 2022 with a lot of other things, but then it recovered, which is interesting. And I kind of questioned that recovery at the time. And it lasted, again, a full year and let's see, like a full 2 years. So some of that recovery I might have expected, but basically earnings stayed elevated, like significantly elevated for an extra year or two longer than I would have expected. And now finally what I would have originally thought some version of what have happened is happening, and earnings are falling and the stock is collapsing. And this stock is in the S&P 500. So it's not like, even though a lot of people don't know about it, it's interesting in that 2020 crash, I bought a lot of stocks that were like the ones that did really well were kind of like Microchip Technology, where they weren't like household names. Kind of like Tractor Supply. AutoZone, a lot of people know about AutoZone, but when they think about investing, like those aren't like the ones that immediately come to mind. And those are some of the best ones that I was able to buy during that time. Still own the other two that I mentioned, but I did take profits in Microchip Technology. So the reason this one's interesting is, so this downturn is actually a little different because earnings are falling like a lot, like a steep cyclical stock would. But if we look at the history back in 2008, which is what I was using to help guide my purchase in 2020, we have an interesting situation where earnings fall 22%, which during the Great Recession isn't really that much, but the stock price falls triple that. So stock price fall, I didn't pick the exact top to bottom, but it was like 65% decline. And the peak was, it was kind of expensive, I guess, at a 30 PE, but it had been growing 45%, 20%. Like it had fast growth going up into that PE, so it wasn't like a crazy high PE. But the thing is, earnings weren't super deeply cyclical, but the stock price was. And so I noticed that, and I was a little worried about it because basically what happened was, if you just use earnings as your metric, this looked like a buy really early on in the 2020 decline. It was a fast decline, and there were a few others like that too. Like it got down to a 10 PE basically. At the bottom, which is close to when we bought. I think we bought on the 16th, according to my records. But it looked like a bargain way before it ever got that low. And so I was trying to figure out, how to deal with this fact that the valuation using earnings looks really good really soon, but I knew the stock was probably going to fall deeper, like a lot deeper, And so that's how I came up with the valuation metric that I'm going to show you. So just so you understand when this is useful. So if earnings fall like over 50% during every downturn, I use a different strategy. The ones I use for deep cyclicals, if you watched my AMD video that I just made a couple days ago, watch that one for that strategy. If it's a business that doesn't really have any cyclicality to the earnings, then I just used an earnings-based analysis where I look at the earnings, I look at the earnings growth, maybe some other things like debt. But basically, I use the earnings like a PE ratio, PEG ratio, and make my adjustments and then try to figure out a valuation that way. So this is a technique that falls in between those, where you have this weird phenomenon where the stock price moves just far more than earnings do, like the adjusted earnings. Now, sometimes you can use basic earnings, and then that explains some of it. But this is how I came about kind of coming up with this. And so here's what I do. Because earnings are falling during these situations, these are both recession situations, it creates a situation where there is a peak earnings period, usually from the year before. Now, this was particularly useful in March 2020 because most businesses had just reported their earnings for the past year. So by February, I knew what the peak earnings were, assuming a recession was coming, which it did. They had just reported, most businesses, their peak earnings for the year, and I figured next year would be lower than that. So I was like, well, I don't know how low any of these earnings are going to go, but I figured they would recover within 2 or 3 years. And so I was like, well, what can I make of this? If I just assume they'll recover within a few years, how do I figure out when to try to buy these? And so I went back to the 2008 recession and I said, well, there's an established peak here, just like there was in 2020. In retrospect, at least. Sometimes you don't know that earnings are going to be lower the next year until they start going down. But I have this established peak of 72 cents in earnings, and I have this established low price, which was like $8.14. I can use those metrics and create a PE ratio. And then if the same type of thing happens again, I can use this previous Recession PE is what I call it, to just roughly estimate how far a stock might fall during a downturn, when earnings are falling and things are bad. And so I did that, a very basic version of it, a very quick version, but it worked pretty well for Microchip Technology. So I was like, okay, maybe there's something to this. And then I started using it in some different ways, really more to actually be careful, because sometimes, like probably this year, analysts thought earnings were going to be higher, and then all of a sudden they got surprised, right? And earnings fell. Certainly this year they did. They weren't expecting them to be this low. So if you have the Recession PE in mind and you're being defensive, if you're not anywhere, if you're late cycle or whatever, you have to use some judgment, you can actually use that Recession PE to prevent you from buying too early. So maybe instead of buying this 20% dip thinking, oh, it looks like a good deal, and then it keeps falling, well, if you looked in the past, if a down cycle is starting, you know that it could fall like 65%. And really these patterns, especially here, we have like 3 years of fantastic earnings growth, a little setback and a big, of course it was pandemic, but big dump in the stock price. And then we get another 3 years of pretty big earnings growth, 17, 40, 30, right? 49, 37, 20. And now this is going to be a bigger one because we have the second year. And probably because it just went on longer, it was bigger, the upcycle was. And so with the pandemic and everything. And so now we're going to have like a more cyclical type downturn, but you can kind of still use the same method, all right? So I can look and I can say, okay, they earned $3.28 peak earnings in 2019. Stock price bottomed at 29.15. Create a PE out of that. And that serves as the base. So let's see. So when I do that for these guys, I get a recession PE of 8.89. Okay. Now, usually what I do is I add like a buffer to this depending on how low the PE is. So normally for like an 8 PE or 9 PE, I'd add like 30% maybe to it, because this is the absolute bottom. Like this is the worst the PE got. This is 2020s. 2020s was worse than 2008s, and it was closer to where we are now, and it looked like we had this big up cycle. It looked like the down cycle was going to be nasty, so I picked the more pessimistic one. And then since I usually increase this by 30 or 40%, because really I just want to kind of get close to where the bottom was in the past. I'm not trying to like, if you wait to exactly get like the worst previous outcome, you're going to miss a lot of stocks. So I just want to get close normally. And then, so I pick like a 10%, 20%, 30%. If the recession PE is higher, like in the high teens, then usually I don't add a buffer. And if it's like 5 or something like that, especially if it was back in like 2008, I'll add like 40% to that. So one of the adjustments I made here is I didn't add a buffer, because this looks like a pretty nasty down cycle that's going to happen, and it might take a couple years for them to come back. So and it might send the stock price lower than it has in 2020, because that was so quick. So I picked the most pessimistic downturn to use as a model. So I could have used 2008. You can just see glancing at it. That's not the recession PE. I think the recession PE was like 11 something. But you can see that it wasn't too bad there. And then the recession PE was like 8 here. So I picked the more pessimistic one. Also, this pattern doesn't look all too different from the one that we're in now, other than the second year of earnings declines. So I just try to pick the one that makes the most sense, make the adjustments around the edges that make the most sense. And then ultimately what I'm assuming is, I don't know what these earnings are going to be, but I figure in 2 years, maybe 3 years, depending on whether it bottoms this year or next year, then it should recover and this cycle will pick up again, right? And so I'm ignoring these earnings because I assume they won't last very long, right? Now, if this was like a consumer staple company or something, or if it was like Estee Lauder or something like that, then that's not usually super cyclical or even partially cyclical, or the market doesn't even usually treat it that way, then it'll be a different story, right? But we know that this is a semiconductor business, and we know most of them are deeply cyclical. And so this is actually probably what we should expect, and it's kind of impressive that they haven't had as much of this in the past. But we also know that eventually that will probably pick up and improve, right? Okay. So if I haven't lost anybody yet, what I want to do, so normally I'm pointing out these metrics, they're all bad, but I'm just ignoring those. That's because earnings have fallen off a cliff, right? And that's why this technique is actually useful. So in order to get down to that 8.89 PE that I showed, recession PE, we have the peak earnings here of $6.02, and then, which I think is in my spreadsheet, hopefully, right here, okay? So this is the peak earnings. That's what we're going to use for the recession PE, and then as the price goes down, we will compare it to these earnings, and then when whatever today's price is, like it's $57 almost, whenever that gets down to close to that 8.89%, the closer you get to that, the closer it gets to a buy. So it's just like waiting for the PE ratio to get to whatever you want it to be, 15 or 10 or 12. Only instead of using these really horrible, crappy earnings of $1.58, I'm using the peak earnings. And the reason for that is because no matter how bad this gets, these peak earnings are the peak. They're not changing. It gives you some stability, because otherwise what happens is this news will keep getting worse and worse. And as you can see in the spreadsheet, the metrics are horrible. Like this is a sell, right? And this is earnings growth is pretty much don't buy, and revenue, 3-year revenue is almost negative. So those are all horrible. And if you keep watching it, they'll still stay horrible, even when the stock price starts recovering, whenever it does, and you'll miss it, right? So you're trying not to miss it, but still get a good price. So when you do that calculation, it should hit the recession PE, if I have this all right, which I reviewed it, so hopefully I do, at $46.54, which is 18.31% lower than where it trades today. So, and if we just go back and think, all right, let me refresh this, it's stuck here. And we think, okay, let's get some of this off here. Okay. So where are we at here? We're at like $56. I mean, and I like to just go back and ask myself if this makes any sense. So, I mean, when I sold it, it was in early 21, it was probably close to $75. So it's already well below that. So that kind of makes sense. It should be below where I sold it after I've made 140% or whatever in a year. And with earnings expected to be really poor. So, and then we can look back at the peak before the pandemic and say, okay, basically it's at that level now, and I'm aiming to buy it 20% lower. We've also had 20% inflation since then, right? So, I'm probably buying it if I get it at the price I want. If we think this is like fair value somewhere around $50, which if we look at the past, that's probably what I'd say. Then, buying it 30% cheaper than that or something like that, inflation adjusted, that's pretty decent, right? It should be pretty good, especially compared to the rest of the market. All this is premised on the fact that it will recover this whole trend. If you look at their long-term trend, 50 cents a share back here to, even if we don't do the super cycle, $3 or $4 a share here in 2022, right? That's fantastic growth, earnings growth. Actually, let's just see what the fast graph tells us it is. I'm going to take that little kind of super cycle bubble off the top, and they still have almost 14% earnings growth over those, like 17 years or something like that, which is great. So if they go back to that trend after this down, of course, after you add a couple years of no earnings growth or negative earnings growth, it's not quite exactly like 13, be more like 10. I would expect high single digits if you take into account the extra years that you might have to wait and the downturns and everything like that. But if you can get it at a decent price, then it should do pretty good. And often what happens is what's happened during these past cycles, like if you bought it close to the bottom in 2008, even just a couple years later, you have 118% return. I got 140 here. That was 118 in 1, 2, 3 years. That's about right for what we're aiming for. Okay. And then it kept going up. If you wanted to hold it longer term, you could do that. But if you get 100 and plus return in a couple years, usually that's good. That's, you can take profit. It depends on what everything else is doing in the market, but you can't complain about that type of return. So this one's a little different, and this downturn is different than the past downturns it's had, but hopefully I was able to explain that concept a little bit. It comes in really handy with businesses that have moderately cyclical earnings, but not super cyclical, but the price falls about triple usually what the earnings fall. It will catch a lot of people off guard. A lot of people will buy too early because the PE ratio will look really good, right? So let's look right here. 13 PE, they probably had like 15% earnings growth. So the people that were buying here at like 70 something dollars a share, when they were looking at that, that's like a PEG ratio of 1. I mean, that all looks really good. And then boom, it falls off of a cliff. So we don't want to do that. We want to be aware of what happened in the past. And some businesses change. They might not recover this time, but if you spread your bets around, usually about 80% of the time these work out pretty good. As long as you buy them at the right at the right price. Okay, if you found this useful, hit the like and subscribe button. I have a weekly picks monthly service over on Patreon for $25 a month and a free tier on Patreon. So check out those links down in the description. And I have a 25% off affiliate link for FastGraphs if you want to give it a try. That's the graphing service here. And I'll see everybody later. Bye.